Chapter 4, The Two World of Interest. The Depth of the Line of Credit, Part 2. The truth about line of credit. When you borrow money through a line of credit, the best way to picture it is to think of your credit card. You are billed only if you use any amount, and you are charged only for what you borrowed that month. When the next month comes, you receive a bill that shows how much you used the previous month. You are then asked to pay at least the minimum amount due, or up to the full balance if you choose. Your credit card, your personal line of credit, PLOC, your home equity line of credit, HELOC, and your business line of credit, BLOC, all work the same way. Each is a form of revolving credit. When you need to borrow again, you simply draw from it. If you have not paid off the entire balance, you can still borrow up to the remaining limit the bank has approved for you. That is how simple interest works. But here's the part most people never realize. The very same principle applies to your checking account, savings account, investment account, retirement account, and even your insurance account. All of them earn simple interest. These are all bank products. The bank pays you for using your money, but only a tiny portion, while they use that same money to make far more. When you deposit money into your savings account or your checking account or even pay your insurance premiums, the bank rewards you with a small return. In exchange, they promise you something that sounds comforting: security. They say your savings are secure. Your checking account gives you access to money for everyday use. Your insurance protects you in case of emergency. Your retirement account gives you a sense of safety for your future. But on the computer screen, what you see is just a number, not your actual money sitting in a vault. The moment you hand it over to the bank, it is no longer truly yours. They now own it, and they lend it out. That's why whenever you try to access it, they charge you fees. Take money out of your checking account, and you might get hit with an overdraft fee or a minimum balance fee if your account falls below a certain amount, say $500. Withdraw a large sum, and there is a withdrawal fee. Send money to another account or to another country, there is a transfer fee. Pay late, there is a penalty fee. Imagine you gave your money to a friend you trust for safekeeping. He says he will hold on to it for you, just for security. You believe him because you trust him. You never actually see where he keeps it. You just take his word for it. He even writes your name in a ledger to show how much is supposedly in his safe. Now, one day, you decide to take your money back, and he says you must pay him interest for withdrawing it. Would you agree to that? Then he adds, since there's only 500 left in the safe, he will charge you another fee for falling below the minimum requirement of 1,000. Would you still pay him? Then he decides to charge you monthly fees if you do not deposit more. When you finally do, he changes the percentage for how much he will reward you for keeping it there. Would you still agree to that? And in the fine print that you overlooked, he included a clause saying he can use 90% of your money however he wants. But he offers you insurance to protect yourself. In case something happens to him, his wife will continue to manage it for you. Of course, there's a separate insurance fee for that. Now ask yourself honestly, do you still believe your money is sitting safely in his vault? Or do you think he is using 90% of it to make himself more money while paying you a fraction of the profit? Sitting, a temporary state. Now let's look at how the bank really earns from our money. When you deposit money in your checking or savings account, it might feel like it is just sitting there, safe. But sitting is temporary. Sitting means waiting for what comes next. Just like when you sit on a chair, you will eventually get up and move. Money works the same way. The bank takes your money while it's sitting and uses it to make more money. They loan it out to other people. When they do this with big loans like mortgages, they earn compound interest over many years. Then they also make more by giving smaller loans or credit cards at higher interest rates or with hidden fees. All of this comes from the same money that was just sitting in your account. Think about what it means to sit. Money in checking or savings earns very little, usually less than 1% per year. Certificates of deposit, or CDs, earn a little more, maybe around 3%. Investment accounts or insurance accounts are like parking your money for a while, and they can earn between 3 to 6% depending on the type. The bank decides where your money sits and uses it to grow their earnings. Meanwhile, you get just a fraction of what your money could actually earn. So even while your money looks safe, it is always working for the bank first. You are essentially lending the bank your money so they can make more from other people's payments, loans, and fees. Understanding this is key to seeing the full picture of how banks profit from the system while your money is temporarily parked. Conclusion: the bank takes your money and uses it to earn even more. They lend it out through loans that compound interest or amortization, making far more than the stated 6%. In reality, it can feel like 100% over time. Meanwhile, they pay you simple interest or non-compounding interest for letting them use your money. On top of that, they charge fees for transactions and access, and you are taxed on what little interest you earn. Your money is working hard, but mostly for the bank. Understanding this is the key to seeing how the system really works and why it is so important to take control of your finances. This is one of the secrets most millionaires use with their money. They follow what the bank does, but in reverse. Instead of letting the bank borrow their money, they borrow from the bank at simple interest and then invest it to earn compounding interest. By doing this, they turn the system upside down, using the bank's methods to grow their wealth while paying only a fraction of what they could have lost.